I hop into M1 Finance here and I look at one of the companies that I'm most interested in, and it is E.l.f. stock. The company is up 63% year to date. Over the past 1 year, it's up 67%. Just 1 year ago, this company was a $32 stock. At the bottom at around mid 2020, this was actually a $20 stock, and today it trades in the mid 50s. Today, the closing price was $54.30, finishing out pretty much flat. Today, we're going to talk about how I just made $1,000 shorting this stock and how I still have an open position against it. This is going to be a very short-term trade, so stay tuned. We're going to talk about the business of E.l.f., how good that they're doing, how high the stock price has gone, and in my opinion, why I think the company's ran just a little bit too far. Because honestly, while the company does have some pretty good metrics, when I look at their revenue growth, they've grown 33% year over year. That's pretty good. If you look at their net income, it is up 104% year over year. That's pretty good. And there's lots of good things about the company. They're paying off debt, they're raising cash, they're doing all the right things as a company. However, I see one major mistake why I wouldn't buy this company if I were trying to go long. And in fact, that leads me to where we're at today, which is why I'm short. Now, to be fair, this is a very small position. It's only a couple percent of my portfolio, which right now we currently sit at about $40,500 based on today's close, based on the big green day today. And speaking of portfolio balance, here it is tracked since starting my YouTube channel, my portfolio holdings, and my performance versus the major indexes. But when we look at E.l.f. stock on here on M1 Finance, which by the way, you can get a free $10 for getting signed up, like the 134 people that have signed up so far. But pulling up E.l.f. stock here, you can see that it's had a massive run up. When it's especially had its big run up was over the past month, up 31% just in the last month, and that's right around the time that they reported their earnings, which they had a huge green day off of. They went up 15% off of the back of their earnings, and in my opinion, I think that this company does deserve to go up. Let's look at some of the major bullet points here. This is directly from their investor relations page, and you can see some of the highlights. First off, their net sales increased 33%. That's very good growth, especially for an everyday makeup company. The gross margin, which means how much they're actually getting to the bottom line for every product that they sell, went up 190 basis points, which is the equivalent to about 1.9%. Their adjusted EBITDA went up 47%, almost a 50% increase. Furthermore, if you want to look at this cosmetic brand versus the other top 5, including Maybelline, L'Oreal, CoverGirl, and Revlon, you can see that E.l.f. is the big winner here. Now, something I want to mention that if you're not familiar with, and this leads us to pretty much the next slide, the most important part of this, and the reason why it's doing so successful in my opinion, is that E.l.f. typically sells low-end makeup products. Now, that's not a bad thing. That's not saying that E.l.f. can't be successful doing that, but I talked to my wife about this, and I asked her about the E.l.f. company, and we've also been together. I've shopped with her, and I've bought her products at Ulta and Walmart and Target and places like that. And E.l.f. typically has some of the lowest priced makeup products you can buy. They're pretty much the best quality makeup product you can get for a low dollar amount, which is good and bad because they are better than some cheap Dollar Tree type makeup, but they're not nearly the quality as some of the top-end prestige brands that typically sell for 2, 3, 4, sometimes even 5x in price versus that of an E.l.f. product. Now, the big reason, and this is the number one most important slide of the whole video, so pay attention to this, their average product selling for about $5 versus many other mass and prestige brands selling for $9 and $22 is because of this recession. Notice how right around the time that this revenue growth really takes off is towards the beginning of 2022 here. You can see that really this takes off the back of the recession. The moment people start to lose jobs, the moment inflation takes place and these makeup products ramp up in price dramatically, that's when E.l.f. becomes successful. And that is the key reason I want to focus on this short thesis today. Looking at the net sales, the adjusted EBITDA, the EPS, all that good stuff is growing. However, this leads us to the actual free cash flow. And I've talked about this before. Let me give you an example really quick. Netflix is a company that I do like. I love their story. I think that honestly the company is probably too oversold. I do not own shares in it for a couple of reasons, and one of the big ones is their free cash flow. I like companies that can actually generate cash to the shareholders so they can use that for share buybacks, so they can use that for purchasing other companies, for research and development, capital expenditures, whatever. And Netflix has a large amount of net income that's growing over time. However, they really struggle producing free cash flow, which in my opinion is far more important than net income because this can actually be used to benefit shareholders. Now, if we hop over here and we look at E.l.f., this is a company that if you look at their annual charts for their free cash flow, it is not heading in the right direction. It has actually gone down significantly since their peak in 2018, and it's gone down year over year over year, and currently down 36% from 2020 to 2021. Now, if you look on a quarter over quarter basis, last year was actually a negative number, so you can't really compare much to this year. However, if you add up these numbers, you can see that the company is going to do somewhere around, let's see, 12 million at the beginning of the year. With the second quarter, they had 30 million. The third quarter, they had 12. And based on their guidance, they're going to do somewhere around $65-ish million of free cash flow. Now, what you can do is you can look at their market cap, which currently sits at 2.92 billion, and you can divide that by their current free cash flow that they're expecting to get this year. However, the one interesting part here is that when you divide that out, you can see that the current price of free cash flow for 2022 is going to be somewhere around a 45. Now, that's already incredibly expensive. Now, let me show you an example of a comparison of a company I like to compare to, which is my number one investment, okay? If you look at my holdings tab here, we have about 36% of my portfolio invested strictly in CRM, Salesforce. Now, if we look at its annual chart, and we look at 2022, and this is fiscal year, so this is actually calendar year 2021, but that's whatever, they have $5.28 billion. So if you look here at their market cap at $148 billion and divide that by last year's free cash flow of 5.28, the price of free cash flow is around a 28. Now keep in mind that's last year's numbers. There's expected to dramatically beat that. They're probably going to be somewhere around 6 billion or so. So actually, if we were using the real information, it'd probably be somewhere closer to like a 25. So keep in mind, this highly scalable, fast-growing software as a service company is incredible and one of the most profitable businesses on the planet, and it only trades at around a 25 to 30 price to free cash flow. However, a company like an E.l.f. currently trades at 45, which is roughly 50% higher than that of a scalable software company like a Salesforce. So this leads me to the trade we're at today. I've made about $1,000 so far shorting this company. That's actual booked profits. I do still have an open position. I have 8 put options for December, and this is going to be a very short-term thing. And this is for 2 major reasons. The first one is you can see that I made a lot of my biggest trades this year shorting. Actually, let's see here. 1, 2, 3, 4. So yeah, 3 of my top 4 plays this year have actually been off of shorts. I made over $3,000 shorting Tesla. I made over $2,000 shorting Bed Bath & Beyond. And I made about $2,000 shorting the SQQQ, which is essentially like betting against the NASDAQ. And that's where I've made a huge part of my money this year. And I am very invested in this market. My positions, I am fully invested, and I even have some margin on my account, which is strictly betting on long plays, betting that stocks will go up. However, I need a hedge in the market, a very short-term hedge. This may only be open a day, a week, a month. Do not expect me to hold this a very long time. However, the $1,000 in book profits has already helped hedge against some of the losses I would have experienced in my overall portfolio, but I think that this company is down to come down at least a little bit, at least back to the $40 a share range. I don't know how long I'll plan to hold it. It'll depend off a couple different things, but essentially, when you look at this company going up 30% in the last month, going up 40% in the last 3 months, over the last 6 months, it's up 156%. At some point, this company has to hit a wall. At some point, this company has to stop growing in share price dramatically faster than its fundamental business. 156 share price growth in just 6 months is pretty incredible, and so far this company hasn't seen any roadblocks, and I think that now is that time when it's finally going to face a little bit of turmoil. If I'm right, I'll likely make some money off this short. If I'm wrong, I'll likely lose money as the company continues to grow off of this recession-based growth story. But in the meantime, I think that this company, with its minimal profits, is likely running out of steam. Thank you guys so much for watching. Check out M1 Finance if you haven't already. Get signed up for a free $10. And other than that, guys, thank you so much for watching, and I'll catch you guys next time.